Again, why I'm bringing this all up is Robert had asked us, I'm thinking about taking a very large position on shorting SPY by using put options, to buy put options on SPY, expecting a decline. What should I look to do? But we do have a tool for you. Following along with the bearish sentiments and the bearish market sentiment indicators that we've been seeing, we talked about last week. But at the same time, you're probably seeing others. You're probably following other services. Your broker probably has a signal that they mentioned. Investors Business Daily has a market trend thing that they have as well. It says, oh, things are flashing bearish. We've been on too big of a run. So Robert's comment was, how can I go ahead and what can I do if I'm interested in finding put options to go short SPY and I'm thinking about taking a fairly large position? Well, again, we have the tool for you. So underneath long call or long put, or under our signature tools tab, you can go to long option finder. Now, of course, we've got the SPX at 5505 right now, SPY at 550, call it that. But let's go ahead and go into the long option finder. And this tool is fairly simple, but you want to put in your inputs. So I'm thinking SPY. And let's just say about a 9% decrease. That's a hard edge, right? That's a big decrease in SPY. We're at 550. Let's say I expect it to drop to 500. And I'm going to put over $250,000 into this. That's what he was referring to as a large. He was actually talking about a lot more. But I'm going to put $250,000 in this position. And I expect that SPY might drop 10%. We're going to see a lot of big earnings coming out in the next few weeks. Let's just go on or near standard August expiration, of August 16th. So at 8:15, SPY drops to 500. I'm putting $250,000 into put options. What's the best put that I could get? Now, this takes a little bit longer because we're using SPY. We'll use a different example in just a moment. But what the tool is doing right now, it's going through the entire chain of SPY, daily options, everything else that's available in the money, at the money, out of the money. And it's calculating the Black-Scholes theoretical price if the stock hit our target price on or near our target date. And it's showing us which put option would give us the best return if the underlying hit near our expected price on our expected date. And as we see here, the 16th of August, 524 put, if we bought 1,141 contracts, it would cost us almost $250,000. Now, probably be more than that with commissions, of course, but we're not going to look at that. The current ask price of these puts is $219. Deep out of the money, 26, 25 points out of the money, $219 price. And if the stock hit our expected price of 500, SPY hit underlying hit 500 on 8:15, it shows us to be worth $23.93. Does that make sense? Absolutely, it makes sense. That's pure intrinsic value. It's 1 day remaining to expiration. So that $249,000 would have gone up to $2,730,000 or 993%. Now the 523, the 522, they're all pretty even with a 992% return and a 991% return. I use an extreme example of about a 10% drop, $50 on 550 or 9% or so. But again, if you're thinking about taking a position, looking at downward market, NDX, QQQ, SPY, TQQQ, for example, on one of those double ETFs, the double bull ETFs on the QQQ, for example, this tool will tell you which put option would give you the best return if the stock did hit your target price on or near your target date. Let's go a little bit less. Let's just go 525, 530. Roughly a 5 or 6% decline, okay? And let's just put in 2,500, but still around August 15th after some of the big earnings come out. Other news might come out politically, Democratic Party, Republican Party, who knows? Let's just go ahead and throw that in. Again, this is has to look at all the daily options that are available. Oh, and a comment does come in. I'll address that in just 1 second. But it's calculating what every option would be worth, whether it be intrinsic, whether using the Black-Scholes pricing model for those options that are still further out in time to show us which option would give us the best return if the stock hits our price on our expected date. Now, when we saw that 10 or 9% decrease, we saw out of the money options that were very cheap were yielding the biggest return. That's what you'd expect. With only a 5% decrease or so, going from 550, okay, 548.99, down about 23 points to 525, naturally the closer to at the money options, slightly out of the money, but at the money options are the ones that are giving the biggest return. See, in this case, since we selected the 16th of August, 15th of August, my apologies, but since we selected that date, those lower price options that we saw, the 500, 505 options that we saw, with those prices, the 525, 521s, that were only $2.90. Well, they're going to expire worthless. We're going to lose money. So with a smaller drop, you're not going as far out of the money. You have a higher cost. We naturally lowered the cost basis down. So we're only buying 4 contracts, but it'd still be a 220% return. And if our stock was at 525, it makes natural sense that 544 put would be worth around $19 intrinsically. Now, down here at the bottom, there's other things you can play with. Naturally, these options look like they have very low volatility, which SPY options always do. But if there was a 5, 7, or 10% decrease, then you expected maybe an increase of 0.05 or 0.06 volatility across the board. You could recalculate it using an implied volatility of 0.20 on the SPY options. That's naturally going to inflate the prices a little bit more because they're going to have a little bit more value on those positions. So it still probably is going to pull up the 544 put for us, but if we change the implied volatility, it's going to be a little bit higher than 220% because that implied volatility would work in our favor. But again, in this case, it wouldn't because we're right at expiration. Even with a higher implied volatility, it's still going to be at intrinsic value. That doesn't come into play on the day before expiration or the day of expiration naturally as well. So just wanted to show that real quick. Yeah, it's still thinking because it's going through all the dailies. But yeah, using ours, so it's still the 220. But let's take something that's further out in time. Looks like the 23rd of August. Let's take that 544 put there. It'd be 192% with our implied volatility of 0.20. August 23rd, 544. So it still had some time remaining. And the August 23rd, 544 didn't really show up. The 545s at 182. Oh, there it is. I'm sorry, folks. So it's at 181 with the regular volatility of 0.14. And it would go up to, what did we say, 191 with our implied volatility of 0.20. That would be the inflated price just due to that little bit of click of implied volatility. So again, you're expecting a market decline. You're concerned about a market decline. You want to add some extra hedge. Long option finder under the signature tools or just under the long call or long put tab. Put in your underlying symbol. CMG has been still dropping like a stone, but let's say that I expect CMG to recover. I think the last price I saw for it was at like 62 or 63, something along those lines. But let's think I expected it to jump back up to 78. I'm only going to put in $1,000 into options, same time frame. Now, this is not a projection. I'm not saying I'm making any recommendation that CMG is going to be back there, but just in that brief moment with a smaller chain, you can see now that it pulled up the deep out of the money calls at the time. CMG's at 53, 54 after the split, and then it kept declining. But hey, if we bought the 68 call for 35 cents, and in the next month it comes back to 75, yeah, I don't know, unlikely, but if it comes back to 75, you'd have a very high expected return. And again, it's sorting it from highest expected return to lowest. So that's the long option finder. Robert, that's the tool you would use, whether you're using just $500 or $1,000 or $2,000 to maybe do some sort of broad market hedge in your portfolio with puts on SPY, puts on QQQ, or on the NASDAQ or SPX, for example. Or if you have a specific stock in mind that you think is primed maybe for a rebound or is still going to continue to decline, long option finder tool will show you the option that would give you the highest theoretical expected return if the stock did hit your target price on your expected date. So that's the tool that you want to use, and that's the tool that's going to help you going forward.